Welcome to you all. Today I'll be talking about inequality, recessions, and recoveries, which is the topic of the annual report which I wrote for the Federal Reserve Bank of Minneapolis. And my name is Fabrizio Perri, and I'm an economist at the research department at the Minneapolis Fed. Okay, so let me start some background. Why do I start working on this topic? And the main reason is that inequality is lately at the centerpiece of the economic and political debate in the United States and in many other countries in the world. As recently as at the beginning of this year, the State of the Union, President Obama mentioned that that's kind of reducing economic inequality is one of the key priorities of his agenda. So what I'll do today, I'll give you basically some facts, which are pretty basic, but somehow a little bit new about economic inequality in the US, and I'll focus on the whole post-war period, starting from the late 60s, and then I'll focus more especially on the period of the Great Recession and the aftermath. And after presenting these facts, I'll briefly discuss what can we learn from these facts that I'll be talking about. Okay, so when we're talking about economic inequality, we're talking about really describing an entire distribution of income across all US households. That's a pretty complicated object. It involves a lot of, for example, very rich households at the very top of the distribution. It involves a lot of very poor households, maybe making zero income or less. But unfortunately, we can't just present all the numbers. So this is a simple way we can summarize the income distributions. I'm going to focus on three particular moments, three statistics of income distribution. One is the top, and this is the income of a household who sits at the top 5% of the income distribution. Then we're going to focus on the median, so that's the income of a household who sits right in the middle. So 50% of households make more than its household, 50% make less. And then a household which is at the bottom 20%. So for these three groups, we're going to focus on two measures of income. The first, the red one here, is going to be market income. Market income is the income the household make before any government intervention. So it's before taxes, before any transfers that it receives, for example, pensions from the government or welfare payments or things like that. And disposable income is market income plus all government transfers minus taxes. So this is the income that a household actually has disposable, available for spending. Now these measures are for all households who have at least one member which is aged between 21 and 60, so like households who are in the labor markets. And those figures are for households, think about a household who has 4 members, 2 adults and 2 kids. So let's first look at market income, and you see fairly large disparities. Top 5% makes about more than 10 times what the bottom 20% makes. So a very large disparity. And the median sits, it's about $75,000. So these disparities are reduced pretty substantially when you go to disposable income. Particularly see at the top, disposable income is less than market income. What's going on? Taxes. These households are taxed by the government, and so they give more than they actually receive, and so their disposable income is lower. The household in the median is pretty much the same, not a lot of difference. The bottom 20%, the disposable income is higher. This household receives more transfer from the government than actually it pays out in taxes. Still, the disparities are reduced, but still there is a big difference between, say, the top 5% and the bottom 20%. So there is a certain level of inequality. That's what is in 2012 in the United States. Now, what we're going to look at is how do we get there? Was inequality increasing? Was much lower before? And so on. So here's the first picture. So now, the first one, we're going to focus on inequality at the top. So we're going to focus in particular on the ratio between the top 5% and the median. So that captures, the opening of the income distribution that happens because the top is taking off relative to the median. And a lot has been said about that, and some of the, for example, the issue of Occupy Wall Street, the top 1% versus 99%. There's been this ongoing discourse in the debate saying that the top part of the income distribution is growing faster than the median. So this picture tells the story starts in 1967 to 2012, which is the most recent data we have. And this is the ratio between the top 95% to the median. The blue is this ratio in market income. The red is the ratio in disposable income, so after government intervention. What you can see that this ratio has been fairly flat and under 3 up until the 80s. And then, starting in the early 80s, it's kept growing at a fairly steady pace. And now it's almost got to 4. So inequality at the top has been growing. The top has been growing faster than the median. People have tried to explain that in many ways. A lot of some leading explanation, for example, involved the so-called skill premium or education premium in the fact that people at the top with very high education have been more able to increase in their wages because they can better manage technology. That's one explanation. Some other people have said that that has to do a little bit with the disappearance of some routine jobs due to globalization. The fact is that this stuff has been increasing, so this is true. Now, this does not include the very, very top of the income distribution, the top 1%, which, other sources of data show that it's growing even faster than this part. The reason why we don't include this here is that it's very hard to get consistent data for the top 1% going all the way back due to so-called top coding privacy reasons, so this data are not publicly available. And the other reason is that I think it's interesting not only to look at the difference between the very top of society and the rest of us, but also to look at the difference between, say, top 5% and the median. It's still a big fraction of society, so it's still interesting to look at these differences. So, well, as I said, we see a big increase in this inequality, and that's sort of well known, well debated. And if you focus on the Great Recession, the Great Recession doesn't look particularly special. It looks like we are continuing on this trend. But the thing which is a little bit less well known is the pattern of disposable income. So in the initial part, in the 80s up to the late 90s, the two lines grow up in a parallel fashion, suggesting that there's been no much changes in taxes and transfers, so more inequality in market income has translated pretty much one-to-one in higher inequality in disposable income. Notice that the blue line is always above the red line, meaning that there is redistribution, but this redistribution, which is sort of the distance between these two lines, has been constant up until the late 90s. But after the late 90s, something has changed in the sense the blue line has kept growing while the red line has stabilized. And so the gap between these two lines has opened up, and the gap is redistribution. So suggesting that even the market income inequality is growing, but the government, through taxes, transfers, is doing more redistribution than it's done in the past from the top to the median. Now, these things is even more apparent if you go at the bottom. So this is the same picture as before, but instead of looking at the top, so the ratio between the top 5% and the median, we're looking at the bottom, ratio between the median and the bottom. So this is not so much how much the median is running away from the bottom, as more how much is the bottom falling off the median. How poor are the poorest fraction of the income distribution. And again, here we see the ratio. So, for example, in the early 70s, the ratio was about 2, meaning that the median was making twice as much as the household, the bottom 20%. Now, we see a little bit of a trend, but the main features we see in this figure is the cyclicality. Now, the shaded areas here represent recessions, agro-recessions. And you see in agro-recession, this figure spikes up in every recession. What is the spiking up represents? Mostly represents increase in unemployment rate. During recession, there's high unemployment rate, meaning there's a lot of households who have members who lose their job and they lose their income. So these households happen to go down at the bottom of the distribution to have very low level of income, and so that's why this ratio spikes up. So as the bottom of distribution falls because all of a sudden in recession, the bottom of distribution is full of households who have very low income. And we see that that's been true in every recession. And overall, there's been a trend in the sense that right now, if you compare before the 71 recession, this level was about 2. Before the Great Recession, this level was 2.5. Now, one thing that's jumps to you when you look at this picture is that how big is this increase in the Great Recession? So in the Great Recession, even though unemployment wasn't really at the highest level in the post-war, unemployment was pretty much comparable to what it was in the 80s, the ratio of income between the median and the bottom jumped up at a level of almost 3, meaning that the income level of the bottom distribution, the market income, was extremely low. One feature which is very special with the Great Recession in terms of inequality is really that is the first time in the post-war in which we see the bottom 20% to being really with very low income relative to the median. Now, what is the government doing about that? Well, the government is doing a lot, and as before, is doing more over time. For example, let's look at the 80s recession. Inequality in market income jumps up in the recession. Well, inequality in disposable income also jumps up, even though much less so. What's going on? A lot of people lose their income because of unemployment, but some of this income is replaced through unemployment subsidy. And some of the also the people who lose their income pay less taxes. So there's less of an increase in inequality in disposable income, meaning that the bottom distribution suffers in terms of market income and not as much in disposable income. And you can see that if you look at this picture, you still see some cyclicality, but much less. And now if you look at the Great Recession, again, what you see is that the gap between the blue line and the red line is at historical high. So it is true that the bottom part of distribution is suffering a lot in terms of market income, but it's also true that the government is doing the maximum amount of redistribution is ever done in the post-war. So one thing that you might wonder is, say, why is it, what's going on? Why is it so, this inequality is so large? What's so special about the Great Recession? And this picture kind of tells a little bit what's so special. And this red line is the same thing we had here, is this blue line. So it's the 50-20 ratio, the ratio between the median and the bottom 20%. This yellow line is long-term unemployment. And you can see that the two lines move in lockstep. And in particular, both lines are at historical highs in the Great Recession. So what's going on here is that the reason why inequality between the median, difference between the median and the bottom are so high is because there is a very large fraction of long-term unemployed. So not only these people are unemployed and don't have income maybe for a month or two, they are unemployed for a long term. So their income is low their yearly income is low, and so that pushes the ratios between the median and the people at the bottom distribution to a very high level. The Fed is worrying not only about unemployment, but now saying we should look at broader indication of the labor market, because this thing suggests that long-term unemployment might be a very important indicator to look at when you're concerned about the welfare of households who are at the bottom of the distribution, the more vulnerable households. So, what I want to take you away from this, I want you to take away from these two pictures is that, yes, it is true that in recent years, inequality, both at the top and the bottom, is high. So the top is growing faster than the median, and the bottom is falling off relative to the median, but redistribution is also a historical high. Now, that doesn't say that the government is doing too much. This is not a judgment value. But what the fact is saying is that inequality is going up, but also government redistribution has been going up. And that's probably a little bit less well-known fact. Now, one thing that I want to stress here, that these pictures are repeated snapshot of the distribution of US households. So we do not fall over time. The households which are in these pictures here are different every year. So we do not really cannot infer what happens to a household, for example, who loses a job. If a household is in the median, around the median distribution, say they make around 70,000, and the next year they lose their job and they make 20,000, what happens to them? These pictures do not tell us that. But as economists, we're lucky enough to have access to a lot of resources, and so we have some data, so-called panel data, which will follow households through time, that can help us understand what happened to that. That's not exactly a question of inequality, but it's connected to inequality, because the reason why we care about inequality is particular inequality at the bottom, is saying, well, are people who are at the bottom, are they suffering? Are they going through economic hardship? So here we follow households, and I select a group of households, I call them vulnerable, and what are the features that makes them vulnerable? Those are households who have the head of household who's unemployed, currently unemployed, and currently suffers a 10% in market income decline. So how can I get a decline? Because I follow this household over time. So I have their income last year, I have the income this year. Well, actually, this is every 2 years. So I have the income 2 years before, the income now, and I can select households who report at least 10% decline. Let's start from 2006. How many of these vulnerable households out there? Not very many, only 2% of the sample. What happened to this household? They suffer, they have at least 10% to be in the group, so on average have a bigger decline. They have a decline in income, about 46% in market income. Now notice that in this is 2006, there's not a lot of government intervention, so when market income goes down 46%, their disposable income goes down almost the same amount. But notice another thing, even though they suffer a pretty substantial income shock, it's 40% decline, or 35% decline, their expenditures do not fall that much. What happens? Probably a shock at the time was not perceived to be a very persistent shock. Long-term unemployment is still not very high, so they do not adjust their consumption much. Also, 2006, the wealth of US households is still pretty high. They're sitting on a house, maybe it has pretty high value, and so they might use some of the wealth to finance the expenditures. As the economy progresses and goes through the Great Recession, you see that what happened, several things happened. First, the group of vulnerable households increased. They were 2%. Now in 2010, they're almost double. More than double, sorry, 5.1%. What happened to the shock? They still face a fairly large shock. But now notice that the gap between market income shock and disposable income shock is smaller, meaning that the government now is helping them more. There's more redistribution, more unemployment insurance going on. So there's more government assistance, but despite that, their expenditures now drop more. So the economic hardship that this household suffer is bigger, and they have to cut expenditure 15%. 15% cut in expenditure is very substantial. Here expenditures are food, education, are primary needs that the household has, and they have to cut them by 15%. What's going on probably is two things, the same things that we discussed before are active. First is that now these households, their wealth is declined, the 401k are still recovering from the shock, the house values are worth less, so they have less liquidity to buffer the shock. And second, now shocks are perceived to be more persistent. Maybe some of these households have been unemployed for a long time, their prospects on the labor market are not very good, and so they're forced to reduce expenditures. So that suggests that there is more government redistribution, certainly. Still, the government redistribution doesn't completely shield households at the bottom of distribution from economic hardship. Okay, so let me now change a little bit the focus here, and I want to again zoom in on the Great Recession, because interestingly enough, the Great Recession has brought up a lot of complaints about the financial sector, but also a lot of discussion about inequality. So I want to look at what happened to inequality during the Great Recession and compare it with another cycle, which is the recession of 82, which is very similar in terms of size, and see how this is different from the previous recession. First, let me focus on market income. And these are the top, median, and bottom. Before the Great Recession, what happened during the Great Recession, the peak years of recession, 2007, 2009, and then what happened during the recovery. So the initial income before a recession, when the recession hits, everybody's hit, but the bottom is hit the most. So the bottom falls by 20%, the top only falls by 4%. That's what we saw before, that during the Great Recession, the inequality between the top and the median, and in particular between the median and the top, increased. because the bottom is the one who suffers more during a recession. That's very similar to what happened in the previous recession. So -1, -10, -20. So these two recessions are similar. The bottom is hit the most, the median is hit in the middle, and the top is hit the least. But the big difference is in the recovery period. What you see is that 3 years after the recession is over, during the recovery, during in the recent episodes, income of all three groups keep falling. The bottom still keeps falling, -26%. The median keeps falling, and even the top keeps falling. So this is really a generalized stagnation. What happened in the 80-82 recession, that all groups were recovering in terms of market income. So it's not so much an issue. Yes, it's still true that the bottom is falling more than the top, but the biggest difference is not that, it's so much that it's more than the fact that every group is falling. And this is even more remarkable if you look at the disposable income. So if you look at the same figures, including government intervention. What you can see in the 80-82 recession, all three groups were increasing. Actually, the top was growing more than the bottom. Instead, in 2010, 2012, everybody's still falling. And not that once you include government intervention, the differences are not so large. So again, suggesting government is intervening, is kind of sharing the pain of recession across all groups. But the main problem is that the main difference between the Great Recession and the previous is that there is a generalized stagnation of incomes. So all incomes below 95% are not growing. And we're not growing 5 or 6 years after a recession. So those are kind of the takeaways, which I just said. At the beginning, the cycles look similar, big increase in inequality. But in the recovery, there was a generalized growth in 80-82, while a generalized stagnation in the recent episodes. Another evidence of this generalized stagnation comes if you look, instead of looking at incomes, you look at expenditures. So this is a whole entire different survey, and it's called the Consumer Expenditure Survey. And so it focuses not so much on income, but it focuses on expenditures of households. And it's pretty much the same group of households we had before. And this is the blue line here represent the expenditures of the bottom 20% of the income distribution. So now, before we were focusing on only the households at the bottom 20%, now we look at all the households we see at the bottom 20%. And the shaded light blue area is the Great Recession, so 2007, 2009. And we see that the bottom was spending about $10,000 per year, and through Great Recession, it suffers 15% decline in expenditures, and they stay down. So pretty large decline in expenditures of the bottom distribution. The right panel shows the ratio between the median, the households which are between the 45-55%, and the top and the middle. So between the households at the top 5% and the middle. And you see that these lines are all flat. What means that these lines the top and the middle kind of follows the same patterns. So expenditures declined, but it declined uniformly across the distribution. Why was that? Most likely because there was a stagnation in income. So that's sort of even when people think about why is this recovery has been not so strong, as one symptom and one way in which we see the weak recovery is in household income and household expenditures. Okay, so let me conclude. Main thing I want to take away from this talk is that, yes, in recent years, after 2010, inequality both at the top and the bottom, economic inequality, are at historical high. But at the same time, inequality is also at historical high. The government is doing a lot of distribution and giving more resources to the bottom distribution, and is doing that at a historical high level. Still, that doesn't mean that households who are vulnerable, who end up going in the bottom distribution because of adverse economic shocks, they still endure economic hardship. Government transfers do not completely shield them from adverse economic shocks. So the last point I want to take away from this data is that the key feature of the Great Recession has not been so much an increase in inequality, but a generalized stagnation. So in previous recession, we saw during the recession increase in inequality, but after the recession, the recovery phase, all income groups were growing. In the Great Recession, we see that all income groups, the top 5%, the medium, and the bottom, have experienced continuous stagnation, even in the recovery phase, in market and in disposable income and expenditures. And so that's what makes this Great Recession particularly stand out and particularly worrisome. So that concludes my talk. And for those of you who are interested in learning more about inequality and looking at some more data sources, please look at the copy of the annual report, which is available on the Minneapolis Fed website.